Hi and welcome to Swissquote's Daily Market Talk. It's Friday, April 4th. Trump's tariffs triggered the worst market sell-off since the pandemic. The US dollar tanks, the treasuries around the world rally as countries retaliate. Inflation expectations rise, growth projections tumble, and opinions diverge regarding what the Fed and the other central banks around the world should or could do next. Okay, so I don't think there is much to say about what happened yesterday. It was a bloodshed really across the global financial markets. Equity markets actually gave such a strong reaction to Donald Trump's tariff nonsense. The S&P 500 lost almost 5%, erasing around $2 trillion in value in market capitalization. Nasdaq 100 tanked 6% and the Dow Jones dumped 4%. It is enormous. Then, Apple, Amazon, Nvidia, Microsoft, Tesla, all of these companies lost big yesterday. We are talking about tens to hundreds of billion US dollars worth of loss in market cap. Then companies that have complex worldwide supply chains like Gap, H&M, and Dell saw heavy losses as well. And when I say heavy losses, I mean heavy. Gap and Dell lost around 20% of their total market cap just at yesterday's trading session. So these are not meme stocks, mind you. These are well-established companies. They're not supposed to lose 20% of their market cap in just a single session. So overall, Trump, who used to gauge his success with the performance of the stock markets, printed the worst start to a presidential term since George W. Bush's first term. And in Europe, while the Stoxx 600 index also lost, it lost more than 2.5% yesterday. The Hang Seng index is down by around 1.5% this morning. At the time I'm talking here, the Japanese Nikkei lost more than 17% since the January peak, and the treasury yields tanked across continents as investors around the world move their money towards safety. As such, gold hit a fresh record high yesterday, while the US dollar index lost around 1.70% at yesterday's trading session. It is a very big move. We are talking about the US dollar index. We are not talking about Bitcoin. So, as I said earlier this week, remember the tariff chaos could help the euro and this week above the 110 psychological mark and sterling above the 130 psychological level against the US dollar. And well, we are actually getting there because the other nations other than the US were less than enchanted by the latest tariff aggression from Donald Trump. Not only did they not look like they were willing to negotiate or whatsoever, but some world leaders out there sounded strongly annoyed and willing to fight back. The European Union, for example, said that there will be a strong response that could actually include measures against the American technology giants and limitations on US investments. And Canada also said that they are imposing 25% levies on US-made vehicles. Voila. We are getting into a typical prisoner's dilemma kind of situation where everyone would be better off with no tariffs, but everyone will be imposing tariffs to each other. Bloomberg even says that the US treasuries are at risk of foreign buyer strike in tariff retaliation. And well, if you think about it, it makes sense not to buy the debt of a country that hits you hard. So this is where we are today. The global economy has now entered a dark tunnel. We can say that with certainty. No one, however, knows what's next. For the Europeans, there's some kind of a consensus out there that the European Central Bank would shift toward a more supportive monetary policy stance than otherwise, as long as inflation in the Eurozone remains in check. And for now, happily, inflation looks like it is on path for the 2% monetary policy target. For Switzerland also, which has been hit heavily with around 31% tariffs, and unexpectedly, the Swiss National Bank is now expected to pull the interest rates down to 0% and even to the negative territory again, to at least counter the Swiss franc's strength and help exporters with macro-prudential measures to keep things together. Now, note that the Swiss pharmaceuticals are not yet subject to US tariffs, which will certainly helped the SMI index weather the tariff shock better than some European peers, but the Swiss SMI index also couldn't avoid a 2.5% sell-off at yesterday's trading session. So for the Europeans, the future looks like there will be lower rates in horizon. For the Fed, however, opinions diverge because UBS, for example, thinks that the tariff chaos will push the Federal Reserve to cut the interest rates 4 times this year instead of 2 to ensure financial stability and maybe slow the economic slowdown in the US, while economists at Morgan Stanley think the complete opposite. They actually think that there is now no way for the Fed to cut the interest rates this year with the rising inflation risk due to tariffs. Now, activity on Fed funds futures looks like they give reason to UBS for now. The probability of a June rate cut shot up to around 95% yesterday, but I don't think that the Fed could act as freely as it did during the global financial crisis or the pandemic, for example. Because at that time, during the pandemic, for example, we didn't have inflation, but 5 years later, we see that inflation could be much stickier than the central banks first thought. And I will come back to that just in a minute, because what's sure is that yesterday's reaction was beyond imagination in response to Trump's tariffs that also came in beyond imagination with quite a stupid calculation, really. That was nothing other than dividing the US deficit with a country by its total exports with that country. So it didn't really make sense at all, and investors obviously react in a way that we haven't seen since the pandemic sell-off. So I'm saying pandemic because indeed, well, you're not talking about virus here. We are talking about Donald Trump, but we are talking about the very risk of a heavy hit to global supply chains that will indeed require very strong reorganization that could take months and even years to become smooth again. As such, it is not crazy actually to make some parallels with the situation of today and the supply chain disruptions that we saw during the pandemic times to try to foresee what could happen next in terms of inflation and monetary policies. And if we do that, the answer is kind of clear. The inflation job that we are about to see could not be as transitory as the Fed thinks it will be. The Fed could make the bet to cut the interest rates despite hitting inflation, and the latter could eventually help stabilize the financial markets, but I don't see at this point how anyone could tame the strong downside revisions to the earnings projections for the US companies and others as well, but especially for the US companies when the global supply chains are put under such a heavy pressure. I guess we will see what happens, but things are changing very rapidly and it's very interesting. Now, I don't know if it matters to anyone, but the US will be revealing its latest jobs data today. On Wednesday, the ADP printed a better than expected figure, and a consensus of analyst estimates on a Bloomberg survey suggests that the US economy may have added around 137,000 new non-farm jobs last month. But either way, the US economy will soon start feeling the pain of these tariffs, as manufacturing jobs that are supposed to come back to the US with these tariffs won't come back to the US overnight, and the latter makes this week's jobs report from the US totally uninteresting in my opinion. Now, what's more interesting, however, is crude oil and a 6% dive at yesterday's trading session to $66 per barrel level on the back of tumbling global growth and tumbling global demand expectations for oil, combined with OPEC Plus decision to restore production more than expected previously. So yes, OPEC Plus countries yesterday announced that they would bring 411,000 barrels a day to the market, and that is the equivalent of 3 monthly tranches from its previous output restoration plan. As such, the supply and demand fundamentals, the supply and demand dynamics of the moment remain comfortably negative for oil right now. Obviously, the US tariffs will hit oil demand much less than what we saw during the pandemic times, as life still continues with or without tariffs, unlike during the pandemic. But the upcoming slowdown in global activity and in the global economy actually reinforces my forecast of a further slide in US crude prices toward the $50 per barrel level sometime later this year. The only hope here is to see Donald Trump and US roll back these tariffs. So this is all for this crazy week. I'm Ipek Ozkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.